Evercore's New York office asked this question in a recent interview. Depreciation increases by $10. Walk me through the impact on the three financial statements. This is one of the most frequently asked technical questions in finance recruiting interviews, full stop. You will get this question if you're recruiting for investment banking at almost every bank that you interview at. And the reason bankers love it is because it tests three things simultaneously. It tests whether you understand accounting, whether you understand how the three statements link together, and whether you can think clearly under pressure. So to nail this question, you need to understand 5 things. First off, what is depreciation? Why does it exist? Second, how does it flow through the income statement? Third, cash flow statement. How does it flow through there? And fourth, how does it hit the balance sheet? And finally, we need to understand how to walk through all of that in a clean and structured way in about 60 seconds. Now, if you're new here, I'm Max Adams, the head coach at Wall Street Mastermind, and I started my career in tech investment banking at Lazard and Catalyst. And now I run coaching here at Wall Street Mastermind, where we've helped over 2,100 students land offers at every single bulge bracket in elite boutique bank on Wall Street. So let's get into it. First off, what is depreciation? Now, before we walk through the numbers, you need to understand what depreciation actually is, because if you don't understand the concept, you'll make mistakes on the math. So let's say that a company buys a piece of equipment for $100. That equipment's going to help the business generate revenue for the next decade. Now, should the company record that entire $100 in an expense in year 1, even though the equipment will be used for 10 years? Well, under accounting rules, the answer is no. Instead, the company spreads that cost out over the useful life of the asset. And so instead of expensing $100 in year 1, the company expenses $10 per year for 10 years. And so that annual $10 charge is what we call depreciation. Now, here's the critical insight. Depreciation is a non-cash expense. The cash already left the business when the equipment was purchased, and so depreciation is just the accounting system's way of matching the cost of the asset to the revenue it helps to generate over time. So if no additional cash goes out the door each year, it's purely a bookkeeping entry. Now, that non-cash nature is the key to understanding everything that follows. So the second thing here is understanding what goes next. And the question gives us a change here, which is that depreciation doesn't stay flat, but it changes, it increases by $10. And so everything else stays the same. You got the same revenue, same operating expenses, same everything, except depreciation goes up by $10. And we need to trace that $10 through the three financial statements. So for a question like this, you usually need to assume a tax rate. And one of the major mistakes that students make is they forget to explicitly state the tax rate that they're saying there. And then I, as an interviewer, am left wondering if they didn't understand the concept or if they just made an assumption and were too careless to mention it. So in our case, we'll assume a 40% tax rate. That's a pretty classic assumption for something like this, because the question is almost either going to give you a tax rate or expects you to assume one, a standard one, like 40%. And so we'll use that here to keep the math clean. So statement number 1, that's what we're going to talk through first, is how this impacts the income statement. The income statement here is where depreciation first shows up, and depreciation is an operating expense. So when depreciation increases by $10, operating expenses go up by $10, and that flows straight down the income statement. So revenue, not gonna change. Gross profit, not gonna change. But when we get to D&A, that goes up by $10. So EBIT drops by $10, your operating income. Interest expense, not gonna change. Pre-tax income, down by $10. Now we apply that 40% tax rate. And so taxes are going to decrease by $4 and net income will drop by $6 total. So here's what happened. Depreciation went up by $10 and that reduced pre-tax income by $10. But because taxes are 40%, the company pays $4 less in taxes. And so the net impact on net income is a decrease of $6. Now, this is the tax shield concept. Depreciation reduces your taxable income, which means that you owe less in taxes. Like the government effectively subsidizes 40% of your depreciation expense. That's awesome. And the 60% that goes is what actually hits your bottom line. And so the formula is simple. 10 multiplied by 1 minus the tax rate of 40% equals 6. That's your net income impact. Now, statement 2 is the cash flow statement. And here's where it gets interesting and where most candidates trip up in interviews. Now, the cash flow statement starts with net income. And we just said that net income went down by 6, so the cash flow statement starts $6 lower. But remember what we said about depreciation. It's a non-cash expense. Like no cash actually leaves the business when your factory depreciates. And so we have to add it back. And in the operating section of the cash flow statement, we always add back non-cash expenses. So we add back the full $10 depreciation. So net income's down 6, we add back 10. And so there's no change to working capital other than that. And cash actually goes up by $4. And so again, why does cash go up? That's the tax shield thing again. Because even though profits went down by 6, we paid $4 less in taxes. And that's what actually matters in this question. $4 in tax savings is real cash that stayed in the business instead of going to the IRS. Now, cash flow from investing, not going to change. Cash flow from financing, not going to change. And so the net change on your cash flow statement is a $4 increase in cash. So statement number 3, balance sheet. Let's see how the balance sheet is affected. Well, remember that the balance sheet must always balance, and so assets equals liabilities plus equity. And on the assets side, cash is up $4. That's the net change in cash that we just calculated. But PP&E, property, plant, and equipment, it goes down by $10. And that's because depreciation reduces the book value of the asset on the balance sheet. And every year you depreciate an asset, its carrying value goes down. And so total assets change by $4 for cash, minus 10 for the asset, aka down 6. And then the equity side of things, nothing happens to the liabilities. It's just that the retained earnings also goes down by 6. And so that's going to flow through, and the balance sheet's going to balance because we've got assets down 6 and we've got retained earnings down 6. And so the key numbers to get right in the interview are net income down 6, cash up 4, PP&E down 10, retained earnings down 6. Know those cold and you'll be in great shape. So let's synthesize that. You've talked a lot about depreciation and amortization. You probably understand a little bit about how it works, but let me give you the version that you'd actually say out loud in the interview room at a bank like Evercore and walk out with an offer. So walk me through $10 depreciation and how it impacts the statements. Assume a 40% tax rate. Great question. Well, starting with the income statement, depreciation increases by $10, which reduces pre-tax income by 10. And so if we use a 40% tax rate, net income is going to decrease by 6. Moving to the cash flow statement, we start with net income down 6, then we add back the $10 depreciation since it's a non-cash charge. And so cash flow from operations increases by 4. There's no change to investing or financing activities, net cash up by 4. And so on the balance sheet, cash is up 4, PPE is down 10 because the asset's been depreciated. And on the liabilities and equity side, retained earnings is down 6 from the lower net income and our tax liability is down 4. The balance sheet balances. So that's it. 45 seconds, confident, sequential, no stumbling. That's what an A answer sounds like. And so to summarize, depreciation is going to impact net income. You got to remember the tax shield. That's a common mistake. And you've got to remember that the cash actually increases and then it flows through the balance sheet. And so the next time you get this question, whether it's depreciation, amortization, any other non-cash charge, this is a very common question format. You've got it. And if you want more hands-on coaching on accounting questions, M&A, LBOs, DCFs, any other technical or behavioral interview question, from coaches who include the former global heads of recruiting at Bank of America and JP Morgan, don't hesitate to reach out to us at Wall Street Mastermind. Link is in the description. And if this video was at all helpful, hit like and subscribe so we know to keep making more. Now, last thing, remember that nothing worthwhile comes easy and nothing's more important than your career and your future. So keep grinding.